Welcome to the deep dive. Today, we're really digging into something pretty significant.
Yeah, the U.S. credit rating downgrade from Moody's.
Exactly. And it's not just Moody's, right? We're looking at the history here, the other agencies, and then kind of zooming out.
Thinking about sovereign debt generally, and importantly, the ripple effects, especially for Africa.
Right. We've got sources like Investopedia, the African Development Bank, Forbes, BBC, Fox 35, a whole range.
Penn Wharton budget model, NDTV profit too. Quite a stack.
The goal, as always for you, the learner, is to make this clear. What's a downgrade? Why did this happen now? How might it affect, the economy and you?
And connecting it to the bigger global economic trends, especially in Africa, without getting lost in the weeds.
Exactly, getting those aha moments. So maybe start with the basics, credit ratings.
Sure. Think of them like a financial health score for a country.
Okay.
They basically assess how likely a government is to pay back its debts. It's all about the risk of default.
And the best score is AAA, or S.
Yeah, AAA from S&P and Fitch is what Moody's uses. It's the top tier.
Got it. And Investopedia says those AAA or rated bonds, they're seen as super safe, right? Least likely to default.
Exactly, which means investors usually accept lower interest rates, lower yields, because the risk is so low.
Lower risk, lower reward. Makes sense.
Yeah.
So what happens when that rating drops, like this U.S. downgrade?
Well, a lower rating signals a slightly higher chance the country might struggle to pay everything back on time.
Okay.
And as, most of our sources point out, that higher perceived risk means the government usually has to pay more to borrow money.
Higher interest rates.
Yeah. Lenders demand more compensation if they think there's a bigger chance they won't get their money back smoothly. It's like your own credit score affecting loan rates.
Right, I see. Okay, so let's talk about this specific news. Moody's. They dropped the U.S. from ELA to AA1.
Yep, that was May 16th, 2025. Forbes, BIC, Fox 35, they all covered it.
And Moody's was the last holdout, wasn't it?
That's right. S&P downgraded way back in 2011. Fitch did it in 2023. Moody's was the last major agency with that perfect score for the U.S.
So why now? What reasons did Moody's give?
It sounds like familiar concerns, honestly. Things the other agencies also flagged.
Like the debt.
Exactly. High and rising government debt, the increasing cost of paying interest on that debt, and the big federal budget deficit that just keeps going. BBC and NDTV Profit mention Moody's pointed to a failure, really over more than a decade, to get those trends under control.
So not a sudden thing, but a long buildup.
Pretty much.
And thinking back, didn't S&P and Fitch also mention, political issues? Gridlock.
Yeah, Fox 35 and Wikipedia remind us of that. Both the 2011 and 2023 downgrades cited political dysfunction, the inability to agree on fiscal policy.
Seems like a recurring theme, this struggle in Washington to sort out the finances.
It definitely seems to worry the rating agencies.
And it's quite something that Moody's held that entry rating since 1917, as the BBC noted. Over a century.
Makes the downgrade feel pretty significant, doesn't it?
Yeah. And what about the reaction?
Well, predictably, political. NDTV Profit said the White House criticized Moody's, called it politically motivated.
Which sounds a bit like 2011 with S&P.
Exactly. Wikipedia mentions back then you had both Democrats and Republicans pointing fingers at S&P and, blaming the other party.
So the economic assessment gets tangled up in politics.
Almost inevitably.
And wasn't there other economic news that same day? BBC and Fox 35 mentioned something?
Oh, right. Yeah, the timing was interesting. News also broke that the U.S. economy actually shrank in the first quarter of 2025.
Oof, not great timing. Okay, so all three agencies have now downgraded the U.S. What are the sort of potential consequences for the economy for you listening?
Well, the most direct one people talk about is higher borrowing costs.
For the government.
For the government, yes. As Fox 35 and Wikipedia explain, higher interest on treasury bonds. But that doesn't always stay just with the government.
Right, it can trickle down.
It can, potentially. Think higher rates on mortgages, maybe credit cards, loans for small businesses. Makes borrowing more expensive across the board.
That's something people would definitely feel.
Absolutely. And there's also the uncertainty factor.
What do you mean?
Well, Fox 35 and The National mentioned this. A downgrade like this can make global investors a bit nervous, create uncertainty.
Like we saw with the stock market dip after the S&P downgrade in 2011.
Exactly. Investors might get more cautious, maybe pull back a bit, which can affect market stability.
And does this put more pressure on politicians to, actually do something?
You'd think so. Fox 35 suggests it increases scrutiny on lawmakers to tackle the deficit, stabilize finances.
And if they don't?
Well, the worry is Continued failure on fiscal reform could lead to even more pressure on the credit outlook. Kind of a negative loop.
Okay, looking further out, what about the long-term debt situation?
Mm.
I saw the Penn-Wharton budget model had some projections.
Yeah, those are quite stark, actually. They suggest that if policies don't change, U.S. debt held by the public could hit like 200% of GDP in the next couple of decades.
200%.
Yep.
That sounds huge.
It's generally considered unsustainable. Their analysis basically warns that without major changes, the U.S. could eventually face a default risk.
A default. That would be catastrophic, wouldn't it? For everyone.
Unimaginably disruptive, yes. For the U.S. and the entire global economy, it really underscores the stakes.
Wow. Okay, so that leads us nicely into the global side of things. You mentioned Africa earlier. How does this connect?
Yeah. The African Development Bank really stresses how linked everything is. Sovereign debt problems in big economies like the U.S. or Europe, they don't happen in a vacuum. They send ripples everywhere.
So how does, say, a U.S. downgrade or debt worries in Europe specifically hit African economies? What are the pathways?
The African Development Bank identifies a few key channels. Trade is a big one.
How so?
Well, if growth slows down in the big OECD countries because of their own debt issues, they buy less stuff.
Right. Less demand for export.
Exactly. Less demand for African exports.
Yeah.
The bank pointed to the 2008-09 crisis where African trade really took a hit.
Okay, that makes sense. What other channels are there?
Things like how easily banks can access funds, so liquidity. Also, how risky countries are perceived to be that affects aid flows, borrowing costs for African nations themselves.
Ah, so it could get more expensive for them to borrow too.
Potentially, yeah. Also affects foreign direct investment, money sent home by workers abroad, remittances, and just general financial market jitters, volatility.
Right, and many African countries rely heavily on commodities, don't they? How does that play in?
That's a key vulnerability the African Development Bank highlights. Economies depending on just a few primary exports, oil, minerals, cocoa, cotton, things like that.
Yeah.
When the global economy slows down, the prices for these commodities often fall, sometimes sharply. That directly hits their export income. We saw that around 2011, too.
Okay, so it sounds mostly like negative impacts. But did the African Development Bank mention any sort of counterintuitive effects? Maybe some positives?
It's interesting, actually. They did observe that around the time of the 2011 U.S. downgrade, even with all the global uncertainty, some investors actually showed more interest in bonds from certain African countries and agencies.
Really? Why would that be?
Maybe a search for yield, or perhaps a view that if traditional safe economies look riskier, then some well-managed African economies might look relatively more attractive by comparison. It suggests some investors might diversify towards certain emerging markets in times like these.
So it's not all doom and gloom for the continent, necessarily.
It's complex. The bank also stresses that lessons were learned from 2008-09. Many African economies are more resilient now, better governance, new trading partners.
But there are still risks.
Definitely. One new complexity they mention is if emerging giants like China, who are now huge partners for Africa, also slow down, that adds another layer of potential risk. It's a constantly changing picture.
Okay, so let's try and wrap this up. Summarize the key takeaways from our deep dive.
Well, the U.S. has lost its top-tier credit rating from all the major agencies now. Main reasons: rising debt, interest costs, political difficulties in fixing it.
Right, and the potential fallout. Higher borrowing costs, maybe filtering down to consumers, plus general economic uncertainty.
Exactly. And globally, especially for Africa, this U.S. situation, along with European debt issues, can cause problems through trade, investment, finance channels.
But interestingly, maybe not all bad. Potential for some investors to look more closely at certain African bonds.
Yeah, that was a notable point from the African Development Bank, a sign of potential shifts.
So that leaves us with a final thought for you, the listener.
Given how connected the global economy is and these, frankly, worrying long-term U.S. debt projections, how should people, maybe investors, maybe policymakers, prepare for what might be coming down the line?
Yeah, and what role will emerging markets, including those in Africa, play in this potentially shifting global financial landscape?
It's a big question, definitely something to think about as we all watch how this continues to unfold.